NVIDIA is up over 200% just over the last 12 months, and with the AI market set to become a 1.3 trillion one by 2032, and in fact a compounded annual growth of 42% over the next 10 years, this leaves room for lots of other strong companies to perform incredibly and outperform NVIDIA, which is already up very significantly. As always, we're going to look at each one of these companies in their historical performance. We'll touch upon their dividend safety, as well as look at some fundamental underlying metrics where we see the growth coming from. And as always, we are going to run each one of these through the valuation model. We want to get to our own intrinsic value, whether or not we believe they are an acceptable buy price of today's market value, and we'll run it through with a margin of safety and see Wall Street themselves whether or not they believe each one of these companies is a buy and what the upside over the next year is. So the first one we're taking a look at today is Qualcomm Incorporated. We have a double buy rating from Seeking Alpha and Wall Street. We do know right now it is trading very strongly towards its 52-week highs. It has a forward yield of 1.58% and a forward P of just under 22. Bear in mind the S&P currently trades at the 22.5 level, and we can also see the market cap 240 billion, significantly lower than NVIDIA, which currently trades around 3.2 trillion. Now, over the last year, some very strong performance, up 75%. Over the last 10 years, up around 170%. Bear in mind, if you reinvest dividends, it would be slightly higher. Now, in terms of looking at their dividend safety score, well, it does sit at 80. It does look to be safe. Market cap, again, 240 billion. It is therefore a mega cap company. And we do note that just last month, it was reaffirmed a dividend cut does look to be unlikely for Qualcomm. Now, the last recession, how did they perform? Well, in fact, they increased the dividend during the Great Recession of 07-09. They had above average growth, negative 7%. Bear in mind the S&P did sit at negative 12, and they significantly outperformed negative 21, where the S&P came in at negative 55. Dividend growth, well, a nice increase just a few months ago, 6.3%. Bear in mind that is above the inflationary target that we want to see on this channel of 4% or more. Over the last 5 years at that 5% point, and over the last 20 years, they've increased that dividend 20% on average year on year. We also note they have been increasing those dividends for the last 20 years. Now, as always, we do like to pay some particular attention to dividend yield theory. Now, it does state a company is undervalued when the current yield sits above the 5-year average. So this is one sign of overvaluation, as well as on the forward PE, just under 21. We can see the 5-year rolling does sit at 16.3, but we do note it is significantly lower than the information technology sector. That does sit at 27.2. Bear in mind though, we're not looking at any of these models in isolation. We will conclude towards the end. First thing we want to look at is the free cash flow payout. Remember, we don't look at the earnings data. It is susceptible to manipulation by management through accounting. Below 50% when we want to be industry specific for semiconductors. Over the last 10 years, quite inconsistent. Nice to note though, over the last 3 years, it has been below 50%, expected again into 2024 at 34%. So in terms of the free cash flow then, we always want to see increasing free cash flows over the longer term. Nice to note it has doubled for Qualcomm over the last 10 years and estimated to increase to around $10.10 over the next 12-month period. So that increase is expected to continue. Now, when we do our deep dives, we do look at the top line revenue and we want to see 3 to 7% growth year on year. What we know for Qualcomm, it has been very inconsistent over the last 10 years. 21-22, we saw some very strong growth, although in the more recent year, we did see a drop of 19%. And when we take a look at it, we can in fact see their top line has grown from 26.5 billion to 35.8, but again, some inconsistency year on year. What they've done very well though, they have returned a lot of excess cash to investor pockets. They've bought back a lot of shares, as we can see, 1.71 billion to 1.13 in the more recent period, which is always nice to see for investors on top of a company that pays some nice dividend growth year on year. ROIC, very important to note. We do want to see 12% or more for semiconductors. This ultimately gives us faith management are able to effectively allocate their capital. very strong, pretty consistently above that for the majority of the last 10 years. 23% also very strong for 2023. In terms of both margins, operating side and the free cash flow, well, it is above the minimums we want to see for the semiconductors. Pretty inconsistent year on year. Nonetheless, 24% is healthy for the more recent year. And in terms of the free cash flow margin, even though it is inconsistent, very strong. This is a free cash flow machine, and 34% on a trailing 12-month basis is very healthy and makes it fairly attractive for potential investors. We then move on to the net debt to EBITDA. So that is the earnings before the interest, tax, depreciation, amortization. Below 1.5 for semiconductors. Remember, these numbers below are the number of years it would take the company to pay off all of that debt net of cash on hand. 0.35 in 2023, 0.1 expected over the next 12 months. So this is a very strong company that has effectively an incredible balance sheet, and that dividend safety score should look to be fairly safe given the low number on the net debt to EBITDA, as well as the free cash flow payout looking fairly healthy as well. So let's jump into the valuation of Qualcomm. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do deep dives where we run through every single one of these models. Today's episode, let's get straight into it, and the intrinsic value comes at around $219. Now, typically what we like to do on the channel is to add a margin of safety before executing on a stock, and we'd start off at 10% and we'd execute on that if we believed it meet our 3 criteria: a wide moat, strong financial metrics, good forward-looking data. What we can see then, for Qualcomm in today's episode, it would be at a 10% MOS level at a buy around $197. So what we can see, it doesn't even have a 5% MOS level in today's episode. So we believe that Qualcomm is trading near enough its current price. So the intrinsic value does sit at the market price of $215 today. In terms of Wall Street and their expectations, well, over the next 12 months, they do believe the share price will go up to around $235. They do see upside of 9%. But as always, let us know your thoughts in the comments below, whether or not you do believe this is one of those strong companies that will outperform NVIDIA, especially given how small the market cap is in relation to NVIDIA's $3.25 trillion. Now, before we do move on to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any others on here, completely free instant access, do click on that pinned comment below. For example, if you want to see the website's resources we use and the screeners, you can find out on this article. Or if you want to find out 12 undervalued high quality dividend stock, again, this more recent article will run through that in quite some detail. The next stock we're looking at is Microsoft Corporation. We have a strong buy rating from Wall Street, a buy from Seeking Alpha, as well as a hold from Quant. We know over the last 12 months, it is up around 31%. If you've been a shareholder over the last 10 years, you would be up 962%, and we can see again very strong right now in an upward trend trading towards its 52-week high, and we can see a forward yield 0.68% and a forward PE just over 37. Now, dividend safety score 99, making it the highest score obtainable. Very safe, market cap 3.3 trillion. It is a mega cap company, and we can see just last month reaffirmed very safe dividend score, therefore concluding that a dividend cut is highly unlikely. Now, last recession, they did in fact maintain the dividend. They didn't cut it, but they also didn't increase it. They had around average growth, and they also marginally outperformed with their negative 48% return. Dividend growth pretty consistent over the last few years, 10% last year, 10% on average over the last 5 years. However, 19% increases over the last 20 on average, and we can see they have been increasing those dividends for the last 13 years. Now, in terms of looking at dividend yield theory, again, similar to the previous company, Qualcomm, we do get a double overvaluation signal purely on the yield as well as the forward PE. We also notice with Microsoft, it is trading higher than the information technology sector, which as we can see sits at 27.2. Now, in terms of the free cash flow payout, for the majority of companies, we do use our blanket rule of below 60%. We can see for Microsoft every single year well below that, 32 expected next year. So again, no surprises. This September, we should see a very nice double-digit dividend increase. And on the free cash flow, very nice increases, nearly 3 times growth, very consistent, and again, over the next 12 months, this upwards trend is expected to continue. In terms of sales growth, well, whilst we want to see 3 to 7%, for MSFT, we're seeing nearly double-digit growth every single year, and nice to note, 14% expected over the last 12 months. In terms of numericals, well, we can see again very strong growth on the top line, more than doubled over the last 10 years. And what they also do on top of that nice dividend increases at double-digit rate, they do those share buybacks, buying back nearly 1 billion of shares over the last 10 years. ROIC, no surprises for this very strong company. Very nice to note, double digit every single year, 31% in 2023. Again, a lot of these metrics make it an incredible, attractive company to consider for investment by investors as well as potential shareholders. Now, what we'd like to see with the margin, not just that it is very strong and above the minimums, but operational efficiency. The margins has gone from 32% in 2014 to 42% in the more recent year. And as we always say with companies, we want them to be increasing not just their top line, but also their margins. Free cash flow, well, purely Microsoft is a free cash flow machine, incredibly consistent, and in fact 30% on a trailing 12-month basis, again showing that this company continues to pull out very strong free cash flows year on year. Net debt to EBITDA, well, what this pretty much signals, over the last 10 years and in the more recent annual report, it wouldn't even take them one day to pay off all of that debt net of cash on hand, even 0.18 expected over the next 12 months, making their balance sheet incredibly strong, one of the best out there alongside the likes of Johnson & Johnson. So in terms of the valuation, let's get to it, and don't forget you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and acceptable buy price of companies in your own portfolio and those on your watch list. Now, in terms of intrinsic value for Microsoft, it does come to just under $428. Now, the current price at $442 does indicate that if you were to buy it now, you would be buying it essentially at a premium. If you were looking for an MOS of around 10%, it would be a buy around $385. For those that be willing to give a 5% margin of safety, again, we can see around $406. In terms of Wall Street and their expectations, well, they see some nice upside to Microsoft over the next 12 months. We did indicate a strong buy from their rating not too long ago, with a price target of $498 and implied upside of 13%. And as always, let us know your thoughts in the comments below. We then move on to Amazon, which we have another strong buy rating from Wall Street, a buy from Seeking Alpha, although we do see that hold from Qualcomm. As we can see, they are trading right there towards their 52-week highs, and this is one that doesn't pay a dividend from the companies that we are discussing today. Forward P at just over 40 and a market cap at 1.91 trillion, somewhere away from NVIDIA. And we can see over the last 12 months up 45%, over the last 10 years up over 1,000%, a very strong company over the last 10 years. Now, in terms of free cash flow per share, well, it has in fact been increasing over the longer term. Notably though, 21-22, they did have negative free cash flow. And what we do find interesting with Amazon is that over the next 12 months, they are expecting some very strong growth to that free cash flow per share. In terms of sales growth, one question you may want to ask yourself is whether or not you see them increasing their top line double digit for the next 10 years as well. They have had some historically strong growth, 12% in 2023, 13% in a trailing 12-month basis, still shows some very strong signs for this company, and we can see they have had some incredible growth over the last 10 years. In terms of shares outstanding, though, the one thing we do want to point out, they would have diluted your position over the last 10 years by increasing those shares outstanding, but given their performance over 1,000%, this probably isn't the biggest worry that you would have had with this company. ROIC, the only thing we want to mention here is that we would like to see a lot more consistency in these numbers. 10% in 2023, 13% over the last 12 months, a good sign, and hopefully we can see a minimum of 10% moving forwards. As we said, that is the minimum we do like to see. Operating margin, well, very low, but the one nice thing to note, operational efficiency, it has increased over the longer term. 6% in 2023, 8% on a trailing 12-month basis. Ideally, we do want to see a minimum of 12%. Hopefully, they can work their way up to this over the next few years. And on the free cash flow margin, again, minimum of 5% is what we want to see, which they have historically hit for the majority of the last 10 years. 6% in 23, 8% on a trailing 12-month basis. Again, hopefully they are now going to really focus on improving these margins. And the net debt to EBITDA, no real worries here. Below 3 is what we want to see. 0.61 in 2023, 0.49 anticipated over the next 12 months. Very strong balance sheet. And if they do start to pay a dividend, hopefully like we will see the other companies that have followed, then this should be a great dividend growth company too. In terms of the valuation for Amazon, well, today we are just focusing on the DCF model, and it does come to an intrinsic value of just under $197. With a current price of $183, margin of safety at 10%, it isn't quite there yet, but on a 5% margin of safety, Amazon does look to be a buy. Again, it really does depend on your investment thesis, whether or not you are willing to either pay a little bit of a premium or a very small percentage in terms of margin of safety. In terms of Wall Street, though, they believe this is some significant upside, 21% in fact. Their price target $221, indicating that Amazon is one you need to seriously consider in your own portfolio. We then move on to a recent dividend-paying company. It is Meta Platforms with a double buy with a hold from Quant. Again, trading towards its 52-week highs, a trailing 12-month yield at 0.2%, and a forward P looking fairly reasonable in comparison to the previous ones at 25.16. And we can see their market cap of 1.28 trillion is nearly 1/3 of that of Nvidia's. Over the last year, again, very strong performance, up 84%. Over the last 10 years, as we can see, up 682%. Now, they have just started to pay a dividend, so they have a 70 safe score. Again, market cap indicating they are a mega cap company. And what we can in fact see during the last recession, they didn't pay a dividend, so no comparative data, but they had above average growth, 154%, very strong, when other companies in the S&P were hovering around -12%. Now, we can't really look at the dividend yield theory given they are a new dividend paying company, but in terms of the forward P, it does sit at 24.4, which is marginally higher than the 5-year average, but we can see it is significantly higher than the communication sector of 18.2. Now, free cash flow payout, the one thing that we will point out here is that it is very low, so we would anticipate nice double-digit increases to Meta's dividend moving forwards. That would be the expectation. Free cash flow per share, well, very nice trend. It has been increasing very strongly over the last 10 years, and in fact, it is expected to continue into 2024, so hopefully, again, this is one of those companies that will really blossom over the next 12 to 48 months. In terms of the sales growth, though, even though it has been decreasing, still on a trailing 12-month basis, 22% is very strong, 16% again in 2023. Maybe one thing to consider, but over the last few years, even though it has gone down from the 58% we saw in 2014, these are some very strong numbers, and we can see over the last 10 years some significant growth to their top line. Now, in terms of share buybacks and share issuances, they've done a bit of both, so we can see very minimal movement from 2014's number to 2023. In terms of the ROIC, well, very strong, not only 26% in the more recent year, but it has been increasing consistently, and 30% on a trailing 12-month basis. Again, it makes it very, very attractive to those who are considering to buy. Both margins looking absolutely phenomenal. Operating side, even though it is inconsistent as we can clearly see, 37% in 2023, and again, free cash flow margin, it has started to decrease, but again, 33% in 23, 36% over the last 12 months. Very strong, something you really want to see from any company you're invested in, and probably the perfect graph that you could ask for. 0 across the board, 0 over the next 12 months. It won't even take Meta Platforms one day to pay off all of their debt net of cash on hand. So let's jump into the valuation model, and as always, if you do want to grab a copy of this, you can click on the pinned comment below and get to both intrinsic and acceptable buy price of companies in your own portfolio. So margin of safety at 10% for Meta Platforms, it does indicate a buy up to $510. At 15%, it isn't quite there yet. So right now, you could be looking into Meta Platforms with an MOS level of 10% moving forwards. In terms of Wall Street and their expectations, well, they have a price target of $534. They see upside of around 6%, and as we saw at the beginning, they do believe Meta Platforms is a buy for the portfolio. As always, let us know your thoughts in the comments below, whether or not you're adding to any of these, whether you believe the future is a lot brighter than these, than Nvidia, which has already got a very large market cap at 3.25 trillion, or maybe you believe over the longer term, Nvidia will continue to outperform these other companies. As always, let us know your thoughts in the comments below. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.